One session, played at speed. Don't watch the candles. Watch where it turns. 3 turns, 3 prices. 10,380, 10,600, 10,680. Now here's the part that should stop you. Those 3 prices existed before the session started. Every one of them was on the chart hours earlier. Nothing turned anywhere else. So this video is one question answered properly. Why does price turn exactly where it turns? And by the end, you'll be marking those 3 prices before the session opens, not after. First, the word, because it gets used badly. Liquidity is not volume. It's not how much traded. Liquidity is orders that are already sitting there, waiting, that will execute automatically when price arrives. Nobody has to decide anything. The order fires by itself. And there are exactly 2 kinds. Above the highs, there are buy orders, breakout buyers waiting to get in, and short sellers with stops that become buys. That's buy-side liquidity. Below the lows, the mirror, sell orders, breakdown sellers, and longs whose stops become sells. Sell-side liquidity. Now, answer this honestly. Where's your stop loss right now? If you're long, it's under a low. If you're short, it's above a high. Same as everyone else. Which means you're not trading near liquidity. You're the liquidity. And once you accept that, the chart starts making a different kind of sense. So the next question is where these orders pile up. And the answer is almost insultingly simple. They pile up wherever a level is obvious. Look at these 2 highs. Same price. To the point. When a market makes 2 highs at the same level, every single trader looking at that chart draws the same line. They all put orders in the same place. That is the strongest pool on any chart, and it has a name, equal highs. The others are just as boring and just as reliable. The high and low of the session. Yesterday's high and low. The high and low of the week. Nothing clever, just the levels a normal person would mark. And there's a second dimension people miss entirely. Age. A high that has stood for a week has had a week of orders piling up behind it. A high from 20 minutes ago has had 20 minutes. Same shape on the chart, completely different size of pool. So when 2 levels compete for your attention, the older one usually wins. Which gives you the rule this whole topic runs on. The more obvious a level is, the more orders are resting behind it, and the more likely price is to go and get them. It also explains something people find backwards. Clean, tidy levels get taken. Messy ones get ignored. Not because the market is cruel, because there's nothing behind a messy level worth collecting. Now, let's take one apart, frame by frame. Part 1. The approach. Price grinds toward the level. Slowly. Lots of small candles. This part is boring, and it's supposed to be. It's the market getting close enough to reach. Part 2. The take. 1 candle. It goes through the level, collects everything resting behind it, and most of that candle is wick, not body. Part 3. The rejection. Within a candle or 2, price is back on the other side of the level, like it never happened. Approach, take, reject. That's the whole shape, and once you've seen it, you'll see it everywhere. And here's the tell that separates a run from a real breakout, which is the thing that actually costs people money. Speed. A run snaps, in and out, fast, and the candle is mostly wick. A genuine break builds. Price goes through and then spends time up there. Bodies, not wicks. Same level. 2 completely different outcomes. If it snaps back, it was a run and the level did its job. If it holds and consolidates above, it wasn't a run, and you need to stop treating it like one. That's a liquidity run. Not a fake out, not a manipulation, just an order-filling event that leaves a very recognizable shape. Which brings us back to the session I opened with. Because price doesn't wander between these. It travels. Run 1. The session low at 10,380. Price grinds down for 26 candles, takes it by 18 points, and reverses immediately. Everyone who was long is now out. Everyone who shorted the breakdown is now trapped. Run 2. The equal highs at 10,600. Price rallies for 28 candles, all the way from the low it just took, and takes them by 21 points. Notice what that means. The first pool funded the trip to the second one. Run 3. Yesterday's high at 10,680. Taken by 24 points, rejected, and that's the high of the day. Draw a line through those three and look at what the session actually was. Not a trend, not a pattern. A route. 3 stops, in order, and nothing in between mattered. One refinement worth having. Pools outside the current range, old highs and lows, are the destinations. Pools inside it are the fuel that gets price moving. Price generally takes the inside ones on the way to the outside ones, which tells you what to target and what to stop on the journey. So here's how you actually use this in 4 steps. 1. Mark the pools before the session starts, not during. Yesterday's high and low, the session high and low, and any equal highs or lows. That's a 2-minute job. 2. Ask which side is more obvious. If the highs are perfectly equal and the lows are messy, you already know which way the market is likely to reach first. 3. Your targets are pools, not ratios. Stop setting a 2-to-1 and hoping. Aim at the next pool, because that's what price is aiming at. 4. And this is the one that changes results. You enter after a pool is taken, not before. Trading into a pool means you're the liquidity. Trading after it's been taken means you're going the same way as the thing that took it. And watch what the level does afterwards. The session low that got swept at 10,380, price never traded below it again for the rest of the day. The equal highs at 10,600, once taken, they held as support. A swept level flips. That's your confirmation the run was real. Now, the part most videos on this topic leave out. 3 ways this goes wrong. 1. Not every sweep reverses. 2. Pools get taken in stages. A big pool might get half collected on Monday and the rest on Thursday. If you expect one clean sweep every time, you'll call it wrong constantly. The sellers were in control the entire way down. That break is the first evidence they're not anymore. You will hear it called a change of character. That is all it means, the first break in the opposite direction. 3. News does not care about your map. A rate decision will go through every pool on the chart without stopping. Liquidity explains how price moves in normal conditions. It is not a forecast. That gap is not a decoration. It is the receipt for the speed of the reversal. The tell for all 3 is the same one from earlier. Speed and time. A run is fast and leaves a wick. Everything else spends time. If price has been sitting beyond your level for an hour, it wasn't a run. Update the map. So the whole thing, in one sentence. Price moves from one pile of resting orders to the next, and the obvious levels are where those piles are. Everything else on your chart is the journey between 2 of them. Every concept people learn separately is actually one sequence, and liquidity is what starts it. One thing to do before your next session. Open your chart tonight and mark 4 lines. Yesterday's high, yesterday's low, any equal highs, any equal lows. Then tomorrow, do nothing but watch which one price goes to first. Next time, what price does in the space between 2 pools and why that's where entries actually live. Mark 4 lines. See you then. 3. News does not care about your map. A rate decision will go through every pool on the chart without stopping. Liquidity explains how price moves in normal conditions. It is not a forecast. The tell for all 3 is the same one from earlier. Speed and time. A run is fast and leaves a wick. Everything else spends time. If price has been sitting beyond your level for an hour, it wasn't a run. Update the map. So the whole thing, in one sentence. Price moves from one pile of resting orders to the next, and the obvious levels are where those piles are. Everything else on your chart is the journey between 2 of them. One thing to do before your next session. Open your chart tonight and mark 4 lines. Yesterday's high, yesterday's low, any equal highs, any equal lows. Then tomorrow, do nothing but watch which one price goes to first. Tell me in the comments which one it was. I bet most of you say the more obvious side, and that's the lesson. Next time, what price does in the space between two pools, and why that's where entries actually live. Mark 4 lines. See you then.